This is John, Amy, and Tim. On behalf of Lois, who couldn't be here for the meeting, we have successfully finished analyzing the Merseyside project, and we're ready to submit our findings. We took a look at 4 different areas here: transportation, sales and marketing, some recommendations on the part of the assistant plant manager, and some treasury options here. So I will speak to the treasury options or treasury issues first. Reviewing the proposal, we noticed that the discount rate for the project is 10%, but there's zero inflation considered. So the first error that we found was in expecting a 10% rate of return, but not properly inflating prices is in error. We are actually overinflating our loss to inflation, which is reducing our NPV quite substantially. So the first change that we made was to not show inflation increases to our pricing year over year. We changed the discount rate to our real rate of return, which is without inflation, 7%. And you'll be able to see here in just a second that our net present value for the project goes immediately from 10.89 million pounds up to 15.06 million pounds. We found that to be a pretty sophomoric error to go ahead and correct. And then all the other adjustments we made from there are going to trim and hone the proposal that we feel you need to consider. So Amy was looking at the cannibalization element, so I'm going to hand off the conversation to her.
Hi, Frank. Yeah, so basically, I just wanted to take some time to address some of the concerns you shared regarding the effects of the potential cannibalization of sales from Rotterdam if we were to do this project. We certainly do believe that this is an important line item to take into account given the current competition in the market. As you mentioned, although there's no actual check being written, if you will, improving cost efficiencies at Merseyside will likely draw production away from the higher cost of production at Rotterdam, which in turn is really going to reduce the margins and overall bottom line of this project. So for those reasons, we really feel that it needs to be considered in our projections. You can see here on this spreadsheet, by ignoring cannibalization, the initial NPV sits at around 15.06. But taking into account the effects of cannibalization, let's start at 0.5%. You can see the reduction to margins still returns a positive NPV and an internal rate of return that's well above that required 10% range. We believe 2% would really be a fair estimate of cannibalized sales, which would reduce the NPV, as you can see on this spreadsheet, by about 2 million pounds. But you can see our NPV is still right around that required return. From a break-even standpoint, we could actually cannibalize as much as 10.46% of margins from Rotterdam before we have an NPV loss or drop below that 10% of our required rate of return there. So really quite a bit of flexibility there in terms of the amount that we could cannibalize from Rotterdam before it returned a negative return on this project. So in addition to the cannibalization concerns, I also wanted to discuss a little bit whether or not these lower costs at Merseyside would enable us to gain a little bit more market share from some of our competitors, as was suggested by the VP. And really what we found is the improvements to Merseyside really wouldn't give us much of a cost advantage when compared to what other facilities are currently producing at. In fact, comparing our index costs after this project were to be implemented, we would actually find ourselves just right in line with our current competitors at around 1.06 to 1.07 percentage cost. So from that respect, this project actually is pretty essential just to enable us to remain cost competitive in the current marketplace. So all in all, I think from a sales and marketing standpoint, taking on this project, not only is it going to yield positive long-term returns, it's really going to enable Merseyside just to remain competitive with the other competing firms in the marketplace. So with that, I'm going to hand it off to Tim.
Thank you. So today I want to discuss a little bit about the transportation options that were provided to us by the Transportation Department. So as part of this program, they expressed concerns about the increase in volume that would be going through Merseyside, and felt that it was going to increase or expedite the timing or the need for them to purchase additional cars. So in reviewing this, we felt there were several options as it relates to this project. The first option is we just completely ignore these costs. We don't believe they're a part of the project. With that, obviously, there's no change. The other two options are we include the cost of the cars within the project, and we look at what that does to the cash flows and the net present value. So if you could go ahead and set the transportation options to include cars. And now if you see that, it dropped the net present value of the project by £1.25 million. So it's a very significant hit. But in reviewing the previous way that the cars have been handled, both from a expense and a depreciation perspective, we really don't feel this is the best approach to handle this within the project. Those cars are owned by a different department. As such, they should handle the expense of it as well as the depreciation of it within their department. We do, however, feel it is a cost of the project to accelerate the cost or the cash outlay to purchase those. So in doing that, we see a net change in the net present value of the project of 0.22. So we do believe this is a realistic hit that this project should take associated with the additional rail car demand, and believe this is the best of the three choices. With that, I want to move on to the assistant manager proposal that was provided to us. So the assistant plan manager proposed that we should bundle an EPC renovation. This is something that he had tried to get approved external to this project, and it failed on its own. And we believe, based on that alone, it should be excluded from this project. If it can't stand on its own legs, it should not be included. But that said, we wanted to consider it, and we wanted to see if including it, given any synergies that may be involved with our project, if it made sense from a financial perspective. So if you could go ahead and change that option now. And as you can see, it is still a losing proposition. The net present value went down by 0.77 million pounds. So until we know more information about how EPC might have synergies with our project even further, we do not believe it should be included in the final proposal for this Merseyside project. And with that, I'll turn it over to John.
Okay, Frank. So just to give you a quick conclusion, we believe that we have the correct return rate in here based on inflation. I believe we are apples to apples between having no inflation anywhere, not in our rate of return and not in our price structure for the 15 years of the project. We have Amy, Amy's got a reasonable rate of cannibalization. There's going to be some. We cannot ignore that. I believe that Amy's got a reasonable rate represented here. The transportation, Tim's got the right outlook on that to the best of our analytics, as well as the consideration for EPC. We just, from a business strategy standpoint, we can be sure that it would save the project should the recession conclude and come out stronger as far as profit margin, but without any quantifiable numbers, we don't have anything to substantiate it, so we need to ignore it. And overall, we are looking at an NPV of 12.71 million pounds, which is obviously a positive number, and we're looking at a correct internal rate of return of 20.65%, which is 10.65 greater than the threshold to be considered for project approval. So if you have any questions, we look forward to hearing from you, and please email us or get us together and we can discuss this further. Thank you very much.